and we are going to kick it off. So thank you so much for joining us today. This is the Introduction to Angel Investing workshop with She's Independent Investments. And I'm Natalie Levy. I will be hosting the talk today. And we also have Rachel Mehta on, who's our deal sourcing lead at She's Independent, who may chime in as well. By way of background, I started my career on Wall Street trading derivatives and also started angel investing earlier in my career. I've been doing it for a bit over a decade, and also spent some time on the private equity side where I ran deal sourcing. I've spent time in various enterprise sales roles on the operational side of growth tech companies. And now I run this Women First Angel group called She's Independent Investments, and really just excited to lean in to education access, host regular events where, we can get some insight out there. And I'm going to share a little bit more about kind of my story and, why I'm here and why I started this, but I'll also say investment track record. It matters. My first 4 investments have a pretty ridiculous return of over 20 times. By no means would I say that that's an expectation that I want you to walk away with. Do not walk away saying I'm going to get a 20x return. Okay, that's not what today's about. But I am excited to celebrate that. And I had a lot of women that said, I want to learn from you. You've done tremendous things on investing. And that's why we're here and why I started. So I'm going to share a little bit more about my journey and story, because I think we all know that your why matters and your story matters. And I'm very open about this. And the reason we're women first and the reason that, I talk about the tough things and I do the tough things is I had a tough journey. I went through a lot of those Me Too moments, a lot of that kind of harassment meets, lack of mentorship and sponsorship in my finance days. And I also saw from my mother, who was not supported and didn't understand, financials. We went through a lot of loss and a lot of tough things in the family. We actually lost her suddenly out of her divorce. A big stressor in her life was finances. Even later in my career, I continue to see these really kind of disgusting things on the harassment side and, hear the Me Too stories. And so I'm really excited today to spend my time and to invest in She's Independent, where it's all about, sharing mentorship, sponsorship, and saying, how do we look at things like this funding gap? How do we look at that gap of learning, of getting more women into finance or into these investing roles? And what can we do about it? And so I'm not just thinking about myself, I'm really thinking about my mom, others we've lost in the family. I'm thinking about, the women and the people after us, and recognizing that for those of us that come from backgrounds where we did not get that organic sponsorship from the start, having a place where you can ask the questions, where you can learn, is something that really can change everything. So thank you for being here. In terms of what we're going to cover, the agenda that I have up is going to be kind of the next 45 minutes, but we are really going to dig into and allow time and space for questions. So if I say something and you're like, what did she say? I don't understand that. Please stop me. Come off, mute. I want to hear your voice. I want to hear it in the chat. If you have the question, other people have the question, and this is very much a safe space where you can truly ask anything. So the agenda of what we're going to cover for the bulk of, angel investing is, why should you think about investing? I want to hear from you and why did you show up, but I'm going to tell you why I think you should invest, and I want to hear your why. And that's something that you can be formulating, thinking about, but it's really about planting seeds today. We're going to talk about equity basics. What is angel investing? How should you think about evaluation? How might you want to get involved, whether you have the capital today or not? So quickly, let's touch on the inequity. We do not live in a world where things are fair, right? And I think we know that. And I think it's something that you hear more and more about. And a lot of it feels a little bit more performative, right? Companies say, oh, well, here's a box we're going to check. Yeah, let's get more women into this. But at the end of the day, are you really encouraged? Are you really supported? Let's talk about the gaps. Everybody hears about the wage gap, but the bigger gaps are what I have up on the screen. The equity ownership gap, where women own 43 cents for every dollar of their male counterpart. Maybe it's how they're navigating into equity comp packages. The valuations. VC funding It used to be 3% or less than 3%. Now we're at 2% of the VC funding going to women-owned. 2%. Board diversity as well. Only 14% of those private company board seats being held by women. So just really significant, being aware of what these gaps are. Let's talk a little bit about why I think you should invest, but let me pause before I get into this slide. Let us know. Feel free to, come off mute, drop it in the chat. What gets you excited about investing or the idea of investing if you haven't yet made the decision to do so? Why are you here, right? Somebody mentioned that they're an LP in a fund, meaning they've invested in a VC fund, but they're looking at angel. How empowering. But, why are you here? What are you looking for? So it looks like we have one budding entrepreneur and somebody who wants to be an investor. Love that. We have another member in the chat saying, looking to fundraise for their startup. And what's great about that is you learn about the investor mindset, because we're going to talk about some of the things we look for. So it's great to think about, even if you're fundraising, how do investors think?
I think for me, it's also just wanting to do something good and positive for those companies or that are starting to start and just don't have the means. So it's more intrinsic than financial at this stage.
Yeah. And listen, the funding gap that we talked about, when we talk to these women-run businesses and they say, wow, you're a group of women angels or predominantly women angels, all are welcome in our group. They're really excited about that. We have white men that don't have diversity on their teams that say, we want to invest in culture and we want women to be on our cap table. So just showing up, whether you're focusing on flow of funds to women-owned or just showing up and saying, hey, we need to change this. It's a hugely impactful space. We have a few more chiming in the chat. Love this. Develop my investor mindset, close the gap for women, looking to invest in other women, access to private deals we can't access alone. Love that. Investing in other women, world-changing companies. Data says women have better results, and I want to do good with my investment money and be part of the wealth building opportunity. Love that. And yes, Gwendolyn, they do say that. The studies say women who run businesses are not only coming up with better results, they're also exiting faster. Okay, love this. Thank you so much for chiming in. So it looks like we have a bunch of great, comments coming in the chat. Love this. Safe place for women to flourish and build companies. Please keep chiming in. We'll continue to kind of dive into the deck, but let me know if you have any questions. Definitely welcome those thoughts. So a few things to think about, or what I think about, and why I got into investing, or back into investing, I should say, because my journey wasn't seamless. It started in the Wall Street, arena, which was very male dominated. I didn't love it. I didn't love investing at that point in time. And, spent all this time and kind of felt the power dynamics and the struggles of being in a growth tech company where you're getting funding, or even being on the funding side in private equity, where something just was amiss for me. It was, finding that alignment, finding that mission-driven thing. It wasn't there. And, for me, I lead with mission, but there are a lot of reasons why I think investing is really a critical component to finding your, professional voice, finding and stepping into that mindset to get, the roles that you want. And we'll talk about knowledge for a second. By being in the rooms, by being in the conversations, and by writing the checks, your access and the knowledge that you can build through that journey, it's limitless, right? You can navigate into new industries. You can, get into rooms that you never could have gotten into if you're an employee. Investor rooms are very different than I'm an employee or I hear what happened in a board meeting. The knowledge gained, it's truly fantastic. We are digging into things like, cap tables. We're digging into, fundamentals and financials. We're digging into these deal rooms. We're talking to founders about things like, what are you doing strategically, at this round in seed or A or wherever you are? And you're really able to gain insight around operations, around the financials. And it's something that you can bring with you and apply to whether it's future investment decisions, or maybe you as a founder, when you think about, those other founders are doing this. I'm learning from that. There's so many ways that you can learn and so much, knowledge that you can gain through the journey of thinking through or, actually allocating investments. The knowledge and access is huge. I've talked to so many of the members that have joined us that have said, wow, these founders, these other investors, they're just like me. I'm able to be in the room. I'm able to ask the questions, and just being able to have that access to being in the rooms, asking the questions. If you're an investor, we're not just talking about the executive team, right? We're talking about the cap table. We're talking about you truly have access to the data and to the people. The network is also amazing, right? I'm not saying everybody should say they're an angel. And, I know a lot of people do this, but getting in the door and having conversations when you're an angel, you can open a lot more doors that way. Career advancement. First, if you're thinking like an angel, that's the only way you're going to leg into an actual sizable, equity package, if that's something you're looking to do, because you really understand the dynamics around what should you look for and what can you expect from an equity ownership standpoint. But when you start participating or thinking like an investor, the way that you're going to de-risk or run diligence on, do I want to join that company? Would I accept equity from this company? Is it going to be meaningful? How do I navigate into, those bigger roles? When you start showing up more strategically, more intentional, when you start entering the rooms of investors, what you can do on the career advancement side also is huge. You can navigate into board roles or advisory roles. And I'm not saying I'd always recommend this, but a lot of these founders out there, they are open to pay for play. So with my angel check, I can secure a board seat or an advisory seat. Maybe that's something you want to add to the resume. So there's a lot you can do in terms of that access and career advancement through angel investing. The last point, but probably to me, one of the most important points, is the power dynamics, those gaps, the money flows. How do you feel? How do you show up? Your mindset truly changes when you start showing up in these rooms. And the people on the other side of that conversation with you, they look at you differently when you have the money. So that's a little bit of, why I think about and how I think about, why invest. But let's talk a little bit more about, why do investors get rewarded? Because an investor is a very different seat than an employee, as an example. So if you're an employee, you're typically going to have that cliff of, the year and then the 4-year vesting cycle. If you're an investor and you write a check, that's immediate ownership. You're not slaving away, working, for years, blood, sweat, and tears, to get that equity. You get immediate ownership. I love what founders do. It is very hard, almost impossible, right, to build those businesses and to be visionaries and actually execute the thing. If you can get the capital, it's easier to invest it than to build the thing. Also, if anybody knows, kind of finance and investing 101, diversification matters. You don't want to be all of, your eggs in one basket, and you don't want one investment. And if you're a founder, I understand, right? You're probably putting, everything into that business for however long it takes. But if you can also allocate some capital, if you're accredited and you can, or maybe, leg into equity, through some advisory work with other businesses, it's much better to have exposure to multiple companies. You don't just want the one. And it's easier, right, to write a check if you have the money than to build the thing. Influence. How many companies out there have that DEI box and they say, oh yeah, we're investing in DEI. Or yeah, we care about the women. But how many of them are actually changing their culture, actually doing the thing for diversity, for changing the way that they operate? When you're an investor, you have influence, again, in different rooms. You're not an employee. You're not an executive in the company. You are in that potentially boardroom, or at least have the founder's ear because you're talking through these concepts. Are they just checking a box, or are they actually doing the thing? You can let your interests known. If you have money, it talks. They are listening, right? You're also, if you're investing, getting these company updates, you're able to, again, make connections, have insight, share feedback. Because once you're an investor, they care about you. You're not an employee, you're an investor. And truly these founders, because they're always thinking about, okay, well, my next funding round, or, the connections, the access to capital, they care about what those investors think and what they say. You have authority. And mentioned this before, but professional growth, right? You can buy a board seat. I have a few logos up on this slide, and these are some of the companies that I've either legged into equity ownership with, or a board seat with, or substantial equity ownership in as an employee, or as an advisor, or as a board advisor. I have a portfolio of over 30 investments today. And what's exciting is, because I started investing early and I started understanding the fundamentals, I was able to say, oh no, I'm not going to accept the equity package you're offering because I know my value, I know my worth, and I'm going to get a much more substantial equity package. And when I leave that company, I know to exercise the options, and I know about the tax implications, and I'm an investor because I think like an investor. I didn't just accept the 10,000 shares that were offered. I knew to ask the questions, and I knew how to leg into actual ownership. And now, by the way, I'm mainly writing checks, but I'm just saying that if you're earlier in your journey, if you're not yet accredited, there are other ways to get equity, and we can talk about that. And what is equity? The term equity, right? It can mean a lot of things. I think about it in terms of ownership. It's participation in upside, a possible liquidity event. Does not mean you're going to get anything from it. Possibly you will. And it's a good for you to know the dynamics, which is it is likely cheap or cheaper for the company to give away than cash. It is cheaper, right? At that point in time when they award it, at least, could be worth a lot more later. But knowing those dynamics, knowing how to navigate this and knowing what equity is, it's all a part of, we want to get you knowledgeable so you know how to navigate and have the conversations. Somebody asked me about, for my investments, did I invest directly or did I do it through funds or platforms? Great question. Predominantly, and almost all of them were directly me, but I've more recently started investing also through She's Independent, and we have direct investment opportunities, but we also have syndications or group investments, and we'll talk about that a little bit later. I also do have some still exposure to some of the private equity funds that I participated in when I was on the private equity side, but the majority of my investments are my own checks, and the majority of them are direct. Great questions. So let's break down and talk a little bit through, what is private investing? How should we think about this, and what are we going to talk about? And so there's a lot of different types of investments out there. We're not going to talk about public markets today. We're really going to be focusing on private companies. There are types of investments and things that you hear about all the time, crypto, real estate, art, other instruments, NFTs. We're going to be talking about private companies. So just want to make that clear. And in terms of what to think about, when you think about the investing ecosystem, what is it? How are we playing? There are different stages of financing. And so angel investing is typically going to be the earlier of the stages of financing. So a typical round or a typical fundraising journey might be friends and family if people have access to capital through people they know. Maybe then they're going to angels. Maybe they're also going to that institutional capital for the seed plus, the series A, B, C, D. And angels can participate really at any of these stages. But because of valuations and because of the, let's say, dry powder of, how much are people going to want to invest, they're typically participating, at least that in more numbers, at earlier stages. Our group, as an example, really likes to look at seed plus, meaning it's early, but there's some de-risking that happens. Maybe the valuation's 10 million. So if it exits at 100 million, there's a good opportunity for upside. If you invest when it's 50 million, you need more capital to play with to have a sizable position. And then also, you're obviously banking on there has to be a bigger exit to get a return on it. Types of financing. There's equity, there's debt. We're going to actually dig into this on another slide, but there's different ways that a company can finance themselves. They could also bootstrap themselves and not take any outside financing, which can also happen. Understanding, the nomenclature, the language, the definitions, part of it is how knowledgeable are you so that you know how to start to navigate around and say, is this an opportunity I might want to invest in? Another question came in the chat, which was, how do you get your pipeline of opportunities? It's a great question. I come from a background in institutional finance, and I've, networked with, and I've been an investor. And so I have a decent network. Now I run an angel group. Not only do I run an angel group, I run a mission-driven angel group. And the amount of deal flow that we're getting inbound because people like what we're doing and they want us involved and plugging into the, other ecosystems and networks. I'm seeing way more deal flow today than I used to because of my role. And being proactive, right? Nurture these relationships. We incentivize our members to actually bring deal flow. We'll actually reward them if we invest in something that, they put in front of us. And so at the end of the day, it's, how are you showing up? We're very much excited about even events like this, right? Putting good information out there. It's branding, it's visibility. People pitch us, on the back of even events like this, and that's great. So pipeline and deal sourcing, it's huge. The more deals you see, hopefully the higher quality deals you can invest in. Because let me tell you something, it is negative selection if you heard from your cousin Vinny that you want to invest in that deal, right? If that's the only deal you've ever seen, it's probably not a good deal. If you see 100 deals and you say, hey, 5 of these look interesting, and I'm, diving into pitches and I run diligence and then I invest in 1 or 2, that's probably going to be a much better methodology. And we'll talk more about kind of what you might want to look for, but investment instruments, to expand a little bit further on this. There are different ways that you may get exposure to that company, to that private company. They may offer you shares, options, a convertible note or a safe note. There's other debt instruments. Angel investing is typically a priced round, meaning they will say we're raising, at this valuation of say 10 million or 20 million or whatever valuation, and you get this many shares. Or the convertible note, which is you get X, discount or this type of conversion into our next priced round. And a safe is a form of convertible note. I'm not going to, spell out everything. Part of this is, introducing some concepts. Options are what oftentimes employers will give you. And an option basically says, as an employee, we want to give you the right to purchase our stock at a certain strike price. And so they're not actually saying, here's the ownership. They're saying, here is a form of ownership, but you have to pay something to exercise or to own the underlying stock. So somebody on this call said, I'm an LP. I'm a limited partner, meaning I'm an investor in a VC or in a fund. I love this slide because I'm not trying to say that we're the best thing ever, even though we're at the top of the slide here, right? But it's basically saying, how do you invest? And we are big on experiential learning and access. If you have a wealth manager, I put some, logos down there, Fidelity and UBS, and you say, hey, invest my capital. It's typically, even if you are, having conversations with that wealth manager, it's pretty hands-off. It's at arm's length. They might tell you what they're doing, the allocation strategy, but they're doing it. A VC fund, you might be looking at different fund managers and saying, where do I want to invest? What are the strategies? Does it align? What are the track records? Great. There's an embedded, I'd say, idea here that if you're going to allocate your own capital, you're going to learn more. It doesn't have to happen that way. You can also invest as an angel and just say, I want to give money. But in this, graph or chart that I'm sharing with you, crowdfunding, individual checks, investment groups, I'm basically showing you that the opportunity to learn and engage, it starts to step up. What do I mean by that? Crowdfunding. What if AngelList has a syndication you can put money in, or some crowdfunding platform? You get information, but you can't jump on a call with a founder because you're putting in $500 or $50 or whatever the crowdfunding minimum is. With us, with our investment group, you get access to the founders. You get access to be able to do all of these things. And so, there's something really great that happens with our angel group, which is you can learn by doing. We're not saying, hey, you have to invest. We're saying, here are some high quality deals that have gone through this cycle, which you could have been a part of in terms of selecting and sourcing. Do you want to invest? Are you interested? It's very experiential, how you can learn. And the change in mindset when you write the check versus, oh yeah, I'm an investor in, or my wealth manager is allocating funds. It's a completely different ballgame when you're writing the check. And so we talked about this already, but really thinking about, what do you learn? What do you get out of investing as an angel? There's so much that you can get out of it. And truly, it's that skill building. It's that influence, and learning alongside others is a phenomenal way to do it. And let's talk about some concepts. What drives evaluation? When I have a founder say, okay, it's 10 million, it's 20 million. And if we're early stages in the business, it's a story, right? They might come up with some, data-driven approach, but at the end of the day, it's usually a vision. It's a multiple, or, an idea of, and this is, the crazy adventure of our revenues are going to explode and they're going to be 300 and 500% year over year. I mean, that's all a story, and those are projections, and it doesn't really mean anything. And so understanding there are things you can de-risk on and things that I look for as an investor, that we look for as investors. But what drives evaluation? It truly is supply and demand and what investor interest says it is. Now, if it's a later stage business, if it's publicly traded, right, it's going to be a multiple of revenues or profitability, EBITDA. But what we're talking about when we talk about angel, we talk about private companies, it's not that efficient, many players. It's really going to be, and it's still driven by investor demand, but it's really going to be, okay, we don't necessarily have a great bellwether, or we can't necessarily look at a public company and say, and these are the market comps. You can have an idea about market comps, but it's really usually at these angel stages, the investor interest, the demand, and the story. And up on the slide, I have a picture of tulips, and it's kind of a fun thing that you learn about in finance, which is tulip mania took a hold of the Netherlands in the 1600s. And it was largely viewed as this first financial, asset bubble. People made and lost fortunes trading tulips, the flower, right? And you may laugh and say, is this real? And it's real. You can read about it. Maybe it's not so crazy, because now you see, some of these NFTs that were trading for $1 million, and then, they're discounted to practically nothing. I mean, asset bubbles happen. What will people pay? What is the demand, right? Robinhood and retail flows, GameStop, you've heard of some of these stocks doing crazy things. Again, people may be making fortunes, and probably a lot of people that don't really know what they're doing, just chasing money flows, but recognizing that valuations are somewhat meaningless, right? At the end of the day, it's what will somebody pay? You have to remember that. And actually, let me go back to valuation for a second. So if there are no revenues, you can still start to de-risk. Who is the founder? Have they exited businesses prior? What have they built? Do they have, already case studies or users that want to pay and they're just launching out of beta? So there are things you can dig into. It doesn't just have to be, real revenues for me to say it's not just at the idea stage. There are things that you can de-risk on. We're not going to be able to cover everything today. I just want to, cover some of these concepts. And let's dig a little bit more into the equity, because some of the terms that I mentioned earlier may be new for you. Do not talk about number of shares. If you are, navigating into an equity package, think about percentage of ownership. Because if you only know the number of shares, you're not going to be able to understand what is the value Or, what is the percent or where is this going? Companies will say, hey, here's 20,000 shares. Good luck. Congrats. What does that mean? It could be 0.001%. If they give you, and when they give you, when you ask for it, what is the percentage of ownership? You can also look at, okay, what was the last valuation? On paper, what is this worth? That's what we want you thinking about. You need to know how to ask the questions to leg into and to understand how to get a reasonable or sizable position, right? Vesting schedules, cliffs, these are things that you have to worry about if you're talking about employer equity. If you're an investor, again, it vests immediately, so you don't have to worry about these concepts. But what is important to understand, let's just say you're not yet accredited, meaning you do not have the credentials to write checks into private companies based on the SEC regulations. You can leg into or navigate into equity ownership with a company. But if you don't understand the cliff or the vesting schedule, and you don't understand maybe what is negotiable, then how are you going to do it? Okay, next slide, we'll talk about this a little bit. What ownership percent can you expect? On the right side of the slide, I have up a few examples of places you may want to look. If I'm interviewing or thinking about, or I have an offer from an employer, I'm going to ask them a ton of questions. But I'm also going to look at some of these websites to say, what does the traction look like? Places like Glassdoor might give me an idea of what equity can I expect for this type of role. Similar comparable positions. If I'm thinking about investing in a business, I might want to see what kind of following do they have on LinkedIn? What does Crunchbase say in terms of some of the triggers for the business? But what ownership can you expect is likely going to be a factor of, a number of components. How big are they? How much funding do they have? What is their traction? What role are you stepping into? Is it leadership? Is it a real executive role? Is it a mid-level? What levers can you negotiate? And please know, HR, hiring managers are always expecting for you to ask for more, and they almost always have room. Almost always. There are hiring bans or, bans at which if they've accepted, institutional capital, they can't give you more than, but you can ask what those bans are. Ask the questions. Be inquisitive, be curious. And so if you're getting started with ownership, you don't have to write a check today. You may not be accredited, or you may just not be ready, and that's okay. But you need to start thinking through, how are you going to get into the equity positions if this is something you want? Is it advisory roles? Is it board roles? Is it equity ownership, because you're an employee? By the way, if it's an advisory or board role, I do not want you sticking with a standard 1 year cliff for your vesting schedule. I want you asking for a 6-month cliff. I want you asking for 2-year or 1 year vesting. And what that means is if you leave before the cliff, you get nothing. And the vesting happens over a period of time. So if you have a 2-year vesting schedule, and if you leave after 1 year, you only get 50%, assuming that you're over the cliff. So if you understand these concepts, you can start legging into, investments before you're ready to write a check. It's really exciting. And there's a lot of tips. We're going to talk a little bit more about, the angel group, but when you start thinking about, okay, what do I do? How do I get started? Have a plan. Oh, we have a question about the cliff. So let's talk about that again. So the cliff basically says you have no opportunity for ownership until you're beyond the cliff. And so typically employers will give employees a 1-year cliff and 4-year vesting, because they don't want to give away equity if it's an employee starts and it doesn't work out and they leave. So typically they have to be there for 1 year to start getting ownership on that option package or the shares or whatever was offered. So when you're navigating into that, your first ownership position, you need to start understanding these fundamentals, and you need to have a path, but you don't need to be accredited, meaning you don't have to be ready to write that check to navigate into some of these equity options. Again, board advisory equity, you could be an employee and you do not need to be accredited to, retain and to own that employee equity package. You still have to pay something if it was options. I'm not going to walk you through all the accounting or all the taxable implications, but it's really important. And what does it mean to be accredited? So there are SEC, Securities and Exchange Commission requirements that say that you as an individual need a certain amount of net worth or income because these are risky investments. You need $1 million of net worth, not including your primary residence, or 200,000, I believe it's the 200,000 of income over the last 2 years as an individual. Or if you are a married couple or married, it's 250,000, I believe, for the income over the last 2 years. But recognizing that not everyone's going to meet that accredited investor status, you can still leg into equity or ownership. The other thing that I like to say and really point out, and maybe it's obvious, but you're really not going to learn unless you do it. I love that they have some, opportunities out there basically to say, okay, well, if you want to play, you can have a theoretical portfolio, but you're not going to learn in the same way. When you're allocating your capital, when you're putting your capital to work, when you're saying, I'm a part of this and I am learning at every step, you're going to go deeper. And the learning alongside others and being a part of an angel group is a really fantastic way to do it. There are angels that write their own direct checks. I've done it. But the great thing about doing it with a group is, oh, I don't know, what is this investment vehicle? Oh, does anybody have background or experience, in that space? You start to learn alongside others that have done it. Other domain experts, that are a part of the group. Others that have written the checks before. Because it is a lot of work, right? And so the way that we invest, our angel group, is we're actually not the only money that's going to go into a deal. We might come together for 100,000 or 50,000 or 200,000, but we're investing alongside other capital because we know at the end of the day, we're not going to have the resources. We're not a fund manager. We're not going to look at every number in that data room. We're going to look at it and we're going to say, does this look reasonable? Do we have questions? But we're not going to pour over everything because we're not paid to do the diligence. So we're investing alongside other investors that we trust or that bring credibility, to the investment. We're jumping on calls, reference calls, we're jumping on customer calls, and it's all a part of our process. But know where you're coming from and also know your gaps. And let's talk a little bit more about how angel groups work. So angel groups will typically have a membership fee, and they typically require that you are accredited to join. We do not require all of our members to be accredited. We have a path if you are not accredited. And we're really excited about that because to have a learning and access path, if somebody is not yet in a position to write checks, that's huge. Talk about, changing money flows and mindsets, talk about access. I don't want every investor to look like me or to look like the white men that came before me, right? What is that path to access? And membership dues, we're trying to make everything kind of reasonable and, something accessible for She's Independent, but you might find that there are no dues, and they may be charging you an arm and a leg on what's called carried interest, or basically what they're taking out of a deal. A lot of groups are charging 20 or 30%, 30% if the deals are better performers, and that really is going to hurt your portfolio. We charge an 18% flat carried interest on all deals, and we're sharing it with members that are doing things to help on a deal-by-deal basis. Some investors out there are charging, $2,500 or $5,000 to be in the angel group. We're charging $950 for the investing member annual dues. And we're charging $375 if you're an investment observer. Arun, great question. It is open to everyone, and we do have some men in the group. We also have some investing couples. I think the important thing is recognizing we care about access, we care about education, we care about our mission, right? But we love the support, from people that don't look like us. And we love to, invite others on that journey of learning. And we have a lot of really sophisticated, really great individuals in the group that maybe are writing checks for the first time. Maybe they did diligence, on the real estate side or on the corporate side, and they're stepping into angel for the first time, and we welcome it. We have active investors, we have passive investors, we have active observers, we have passive observers. The other thing is deal minimums. If you are accredited and if you want to be an investor, what is the deal minimum to play? Typically, and it really depends on, what the founder is doing with a fundraise, a lot of times deal minimums are 25,000, 50,000, 100,000. Sometimes they're lower. Sometimes we can leg into or, find a founder that'll take a $5,000 or $10,000 check, but typically they're a lot higher. What we're doing is we're forming these group investment vehicles called syndications. And so we can accept checks as low as $2,500 if you're accredited. Our average check is probably more like $6,000 or $7,000. And we're also finding that newer members are coming in for typically deal minimums. And then they're stepping up and they're doing more as they gain the confidence and they gain the experience. So it's really exciting to see. Great question, Gwendolyn. So we've only been around for a little bit under a year, actually. So I have a financial background, and it's something that, I've been angel investing for, as I said, over a decade, and I have some real wins, but our group's only been around for about a year. We've done no paid marketing. We've really just started, the journey of kind of building up, scaling, but we have over 70 members. We did 10 deals last year across group syndications and deals where multiple individuals invested directly in a deal, 13 deals when you include the direct investments that were also a single check. And that was $550,000 that we allocated last year. I think this year we're probably going to allocate, over $1 million, hopefully closer to 2 million or more. And it's really exciting. Is your group open to accredited investor founders who are actively raising? Absolutely, Cynthia. Phenomenal question. We actually have a founder right here. I'm going to call her out, Rebecca Locke. Give us a little wave. We invested in Rebecca Locke, women-owned business. She started and is building this fantastic business that I'll actually let her give you a sentence on it. And if you want to share anything about us.
Hi, guys. It's so nice to meet everyone here. I am such a fan of She's Independent, which is literally why I'm here. I adore your content. KidKaboo is an Uber for kids. It's B2C, unlike many others in the children's transportation space. So we are someone who parents can directly book rides through. We transport children safely with safety enhancing tech, et cetera. And it was really an honor to meet and go through diligence and get to know She's Independent. I think if you're a new investor, I can't imagine a group that has vetted opportunities more than this particular group and is as thoughtful about investments as this particular group, in my experience. Yeah, I'm a huge fan. I don't know if there's anything else you'd like me to say.
No, thank you. I swear I'm not paying her. That's wonderful.
No, she's not. I didn't even ask me to be here.
Well, we give them capital, but no, Rebecca's tremendous. And just to answer another question that came, through the chat is, what are our deals on average? We have a quarterly pitch cycle, which is pretty normal for an angel group. Our time to invest, after we run a pitch event is maybe 4 to 6 weeks, maybe sometimes a little bit longer, but we have a diligence process. As Rebecca said, right? We're not just writing the check, we're actually going through the motions and saying, what does the risk look like? Do we like, and are we seeing execution? We have a number of questions that we ask. And so the pitch cycle happens quarterly. Our next pitch is next week is going to be our Q1 pitch event. We have 4 companies pitching live. We have a 5th that's going to give us a recording because they're out of Israel. And last year, as I said, we were very active on the deal front. So these pitch events are a really great time to come together and say, what do we want to invest in? And then we additionally offer sometimes off-cycle opportunities that are high quality that come up. Amy has asked, how do you determine the deals? How does the group decide? Rachel and I were going back and forth on this one this week, but we have a voting mechanism. So we're very much run in such a way where everyone's interest and everybody's feedback is heard. So what we do is we have a sourcing and screening process. Anyone can be a part of it. We go through that process to say, do they align with us? Are they open to our check size? Are they aligned in terms of who we are and what we bring? Are they meeting, the basic criteria of what we want to look for in an investment? And we put together a list of, let's say, 10, 15, 20 companies. And then we have our investing members vote on those companies. We apply a rubric to say, based on interest level, what is the interest? And then we look at the ones that had the most interest, and those are the ones we end up inviting. We sometimes also have direct deal opportunities where people can write direct checks if a company did not, place in those top pitch event slots, if they're open to smaller checks. So that's how it works. And so getting, a little bit back to this slide and how angel groups work. I mean, if you're evaluating, thinking about, how do you want to invest? And I so appreciate Rebecca chiming in. I mean, you really want to look at, okay, well, what is the group and what do they do? And maybe you can sit in or hear, what have they invested in, or what does a typical event look like? Because I'm telling you, I've seen some other angel groups, and understanding quality caliber of deal flow and of diligence, that matters. Again, I'm not saying expect 20x investment returns, but what I'm saying is make sure that if you are investing your hard-earned dollars, make sure you're doing it in an intelligent and thoughtful way. Yes, Rebecca.
Just want to add one thing that was very unique about you guys. If people are considering joining, investing with you guys, you were the only group that I observed, and I've talked to hundreds of VCs over the last few years, and investors. You guys were the only ones who actually went out and looked for, you didn't take for granted that the opportunities were all going to come to you, the good ones. You went out and made sure that you had access to or communication with all of the good ones out there. And I had never observed that with any other group. And I thought that was truly tremendous. You truly are going out to look for the best.
Thank you. Yeah. And for example, we found Rebecca because our members truly are, looking in the market and saying, how do we plug in? How do we find things? And they're bringing those deals to us. And so it's not just my network. It's every time we add, we just added our 73rd member, and it's okay, great. That's another network we can open up. Okay, so Gwendolyn asked, are the deal reviews happening during the day, evening, weekend? If you can't attend, there's a delayed input mechanism after the video review. So we record everything. We try to run our deals. Typically, I'd say I'm in Mountain Time, and a lot of times they're kind of my afternoon or midday, recognizing that we have some members rest of world, but we have some members West Coast, some members East Coast, but we record everything. And so if somebody wants to be kind of a leader on the deal team, and if they can't make the regular, meeting we have scheduled, we could talk about updating it, but we very much take input outside of the live, as well. We have a Slack for everyone. We have emails, back and forth, the voting mechanism, and just the ways you can, offer input. It does not just need to be in the live format. Great question. We're also working on, I should say, having kind of these outposts or, local communities and groups that are meeting offline. And so I'm in Boulder, Colorado, and a lot of our members are in Colorado. Rachel, who's on this, she's in New Jersey. And we have a lot of members, in New Jersey and some in New York. We have a cohort, Austin, North Cal, SoCal, so all over the place. And basically just saying, okay, well, if some people also want to meet offline, we recognize that it's also really nice to have that connection. But all of our events are offered virtually today. So I guess here's a screenshot where you can actually see us in the middle of a pitch event and just sharing a little bit more about us, but really about experiential learning, right? We have sponsorship available. Let's just say somebody on this call can't pay for the Investment Observer membership and they're really interested and they want access. We actually have some people paying sponsorship dollars, and we can allocate that to those that might want to join who do not yet have the money to even join as an observer. So not for an investing member. If you're accredited, you can't get those sponsorship dollars, but we have some women that are out of school or in school, and they're really excited about being on an investing journey, and they just don't have the capital today. Love your note, Cynthia. Thanks. And so we'd love to hear from you. Here's just a quick glance, at the portfolio based on what we invested on last year, the 10. And I just want to remind you, right? This is inherently risky. Do not expect returns. I've highlighted or italicized the thing at the bottom, which is expect to learn, expect to connect with great people, access, but please do not come in saying, I need to get a 5X, on this deal. That's not how you should think about angel. It is risky. If you are investing by yourself, or if you're newer to investing, it is oftentimes negative selection, right? Who's coming over LinkedIn cold? Those aren't typically the deals you want to invest in. Just want to remind you, I have a finance background. A lot of people that start angel groups think it's sexy and think it's cool. They don't have the background, okay? So what do you want to get involved with? do you want to learn, right? What are you looking for? And so that's what we had prepared today. You had some great questions. Thanks so much. Rachel dropped in the chat the observer membership sponsorship survey. If somebody, again, cannot pay for sponsorship and they're interested. Jenna asked a great question. Can you provide some thoughts on sourcing deals? Yes. So I'll give you an example. One of the events that we dropped into this year, which had a bunch of deals, was the Y Combinator. I'm trying to think what class it was, but the Y Combinator class. And I'll actually back up in our deck because Lion Pose and Tarot were both Y Combinator companies. Lion Pose is a clinical skincare company for people of color. Tarot was not women on the executive team, but what they were doing, we really loved, which was kind of this membership community and how do you, support and have sponsorship and learning and development for software developers. And so this learning community that we really like the founders of. Y Combinator, just to mention, it is an accelerator that's based, I guess now all over, but started in the Bay Area, and they just have a lot of startups that go through their program. So if you have any questions, again, you can keep chiming in and asking them. My email's up on the screen, our Instagram's up on the screen. We're also offering a little bit of a promo, so you get 10% off if you use the code FROMEB, if you sign up for membership. So let me drop, actually, Rachel, if you could drop the membership link, the sign up link, and I am going to drop the promo code. 10% off your dues for the first year. But yeah, I mean, listen, you have great questions. It sounds like, a lot of you are engaging with and really interested. So this is a lot of fun. I got another direct question to address. And actually, before I get to this, we're also going to host an office hours next week. So that if you have more questions on membership, you're welcome to drop in. A lot of times people want to jump on one-on-one calls before joining, which I'm happy to do if it works, but I have a little bit of a busy schedule with our pitch event. So our Eventbrite is going to show you that office hours event next week if you want to sign up. But you are more than happy to, email me and connect one-on-one as well. So let's see, the question that came across that I wanted to speak to, some people wanted to know about exits. So, what are the expectations? How do you avoid being cut off the cap table? Basically the way an investment works is the typical timeline, it really is kind of up in the air. The last I saw, the data points from CB Insights, which is a pretty intelligent, private company data player, they'd said that it was over 7 years for a women-owned company to exit on average. It was over 8 years for a male-owned company. Just mentioning, right? The women-owned company happened to come in a little bit sooner, but maybe we invest and the company's been around for 2 years. I have seen liquidity sometimes happen after 3, 4, 5 years. I also have, a multiple times unicorn that, it's been 8 years and, I'm still invested actually now 9 years, but they're doing amazing things. So timeline, expectation, don't expect your money back. These are illiquid, meaning, there may be a liquidity event or not. In terms of being cut out of the cap table, as an investor, we're basically signing the same term sheet as other investors in the round. Things can happen, right? They can say, oh, we're taking new capital, we're downsizing, existing investors. That's not a typical scenario, that's atypical. If you come in and you are, signing a term sheet, or I shouldn't say term sheet, but basically signing and executing the documents to be an investor, you have, I'd say, typically, kind of more rights and you're on a better trajectory of than employee equity. This is something where you're stepping in, you're getting the same rights, or we're making sure you're getting the same rights as other investors of that round. And part of diligence is, do we trust, are these credible founders? Are these people that we can really get behind? It's a marriage when you invest, right? I'm not saying that I'm necessarily going to invest at every stage from there because, investing at the angel round because of, how much capital I have makes a lot of sense and it's aligned, but I want to trust that the people I'm investing in, are doing the right thing by their investors. And so that's a part of diligence. Great. Thank you so much, Claire, for chiming in. Thanks, Janine, Katerina, Cynthia. Oh, and then Rachel dropped the membership information. Oh, wonderful, Sophie. We can't wait to have you. All right, I think that was the comments. Feel free, you're welcome to come off mute, say hello if you have any more questions, but what a pleasure. And I'm so glad to see some faces on this snowy day here in Colorado. Any more questions, or shall we, I guess we're right up to the hour. Thanks, Love Malone. All right, so I will stop the recording and